If you're a director of a UK company, have you ever thought about borrowing a little from the business? Just to cover a personal cost? It seems so simple, doesn't it? A quick transfer to tide you over. But hold on, there's a hidden tax trap called the S455 charge, and it could cost your company a fortune. In this guide, we're going to show you exactly what that trap is, and more importantly, how you can get that money back. And look, we can dive deep into this topic today because this entire guide was put together by the experts at Pro Tax Accountant. They live and breathe this stuff, so you know you're getting top-tier practical advice for navigating a really tricky part of UK tax law. So let's get into it. So let's just start with a really direct question. Be honest, have you ever borrowed money from your own company? Maybe for an unexpected bill or to help with a house deposit. It is incredibly common, but what you do next is what really, really matters for your company's finances. Because if you have, you need to tread very, very carefully. There's a tax trap designed specifically for this situation. It's called the S455 charge, and trust me, it can take a serious bite out of your company's cash flow if you're not ready for it. So just how big of a bite are we talking about? A whopping 33.75%. Let that sink in for a second. That's the tax your company has to pay HMRC on the outstanding loan if you don't repay it in time. So for a £20,000 loan, that's a sudden $6,750 tax bill you have to find. That simple loan, well, it doesn't seem so simple anymore, does it?
All right, so here's our game plan. We'll start by digging into the loan trap itself. Then we get to the good stuff, getting your money back. We'll cover some smart ways to repay, how to avoid the common pitfalls with HMRC, a few key exceptions you'll want to know about, and finally, your next steps.
Okay, let's jump into our first section, the director's loan trap. What on earth is this S455 tax charge, and how does it catch so many people out?
S455 tax is, at its heart, a temporary penalty. It applies to what HMRC calls close companies, which, let's be honest, is just jargon for a small UK limited company controlled by 5 or fewer shareholders. Sound like your business? Well, when one of those shareholders, a participator, takes a loan and doesn't pay it back on time, the company gets hit. But the key word I want you to remember is temporary, because you can get it back.
This timeline makes it crystal clear. Let's imagine Sarah, a director in London, borrows 20 grand in February 2025. Her company's year end is March 31st. The moment that date hits, a countdown begins. She has exactly 9 months and 1 day to repay that loan in full. If it's not paid back by January 1st, 2026, her company owes HMRC that huge £6,750, and it's due right along with her regular corporation tax. You need to have that date circled in your calendar.
Okay, so you've paid the tax. That stings. But now for the good part, getting that money back into your business where it belongs. This section is your step-by-step guide to making a successful claim.
And the really good news is this isn't a permanent tax. Once that loan is fully repaid, you can reclaim every single penny. But, and this is a really big but, HMRC won't just send you a check in the mail. The process is not automatic. You have to actively go and ask for it back. They are more than happy to hold on to your cash for as long as you let them. Okay, so here are the 5 key steps. First, the loan has to be officially sorted, repaid, released, or written off in your company's books. Second, and this is where people get tripped up, you have to wait. You can only submit your claim 9 months and 1 day after the end of the accounting period in which you repaid it. Then you pick the right form, gather your proof like bank statements, and finally, you file that claim. Now let's look at the next step, choosing the right form, because this is vital to avoid delays. If you're reclaiming within 2 years of when the loan was first made, you'll use Form CT600A. It's actually part of your main corporation tax return. But if more than 2 years have passed, you need a separate form called an L2P. Getting this right from the start saves a whole lot of headaches. And here is a pro tip you absolutely cannot ignore. You have a hard deadline. You must make your claim within 4 years from the end of the accounting period when you repaid the loan. If you miss this window, that temporary tax becomes a very permanent and very expensive gift to the taxman. It is a use it or lose it deal.
So, we know we have to repay the loan to get the tax back. But how you repay it can have a massive impact on your personal tax bill. This isn't just an accounting task. It's a huge strategic financial decision. So let's look at some smart, tax-efficient ways to do it.
This table is, well, it's incredibly revealing. Just look at the difference for a £20,000 loan. If you repay it with cash from your own bank account, it costs you nothing extra in tax. Simple.
But what if you pay it back through a company dividend? Well, that could cost you £1,750 in personal tax. Now look at the salary or bonus option. That could cost you a staggering £5,600 in tax and national insurance, plus your company gets hit with another £2,760 bill. The difference is absolutely huge. And this isn't just theory. Here's a real-world example of that pricey lesson. A director owed her company £25,000. She took a bonus to repay it, which cost her $7,000 in personal taxes. A dividend would have only cost her a little over $2,000. That's a nearly £5,000 mistake. The bottom line is this: planning your repayment method is just as important as making the repayment itself. But that's not all. Here's where most people go wrong. HMRC has some very specific anti-avoidance rules that you just have to know about. This section is all about the common traps and how you can stay on the right side of the law. The biggest trap has this cozy-sounding name, bed and breakfasting. It's not cozy at all. This is where you repay a loan just before the deadline to avoid the tax, only to take out a very similar amount a few days later. HMRC sees right through this. If you take out a new loan within 30 days, they will treat the original loan as if you never paid it back at all. The right way? Wait more than 30 days and make sure any new loan is for a genuinely new reason. And if you get it wrong, the costs add up fast. For the 2025/26 tax year, you're looking at a late filing penalty of up to 5% of the tax you owe, plus late payment interest, which is sitting at a painful 7.75%. These are completely avoidable costs that just come from poor planning. And make no mistake, HMRC is on the lookout. Here's a quick did you know for you. In 2024 alone, they recovered £15 million in underpaid S455 tax. That's a 25% jump from the year before, which tells you their scrutiny is only getting tougher. This is not a rule they let slide. Okay, stay with me, because it is actually possible to avoid S455 tax altogether in certain situations, and this next point might surprise you. In this section, we'll cover the key exceptions and some really valuable expert tips. There are a few key times when this tax just doesn't apply. The most obvious one is simply repaying the loan before that 9-month deadline. But beyond that, if your company's actual business is money lending, this rule isn't for you. There's also a really important exception for small loans, that's under £15,000, to a full-time employee who doesn't own a big chunk of the company, so more than 5%. And here is another fantastic pro tip. If the company charges you a commercial rate of interest on the loan, HMRC's official rate for 2025 is 3.25%, then it's treated as a normal commercial transaction. Do this, and you can sidestep the S455 charge entirely. Now, there might be a small benefit in kind tax to think about personally, but it's a very clever way to avoid the much bigger S455 problem. But what if the worst happens? This is a critical question. What are the consequences if the company becomes insolvent or has to be closed down while a director's loan is still outstanding? This is the dreaded double whammy. If the company is liquidated, the S455 tax is still due from whatever assets are left. But on top of that, the liquidator will come after you personally for the debt. And if it can't be repaid, that loan amount could be reclassified as income or a dividend, hitting you with a massive personal income tax bill. It really is the worst-case scenario. Okay, we have covered a huge amount of ground, so let's bring it all together in our final section and talk about your next steps, along with some key takeaways to remember. So if you remember nothing else from today, remember these 5 points. The tax is 33.75%, and it's triggered by that specific deadline. It is reclaimable, but you have to act within a 4-year window. How you repay has a massive impact on your personal tax bill. Don't play games with bed and breakfasting. And finally, keep meticulous records. Everything else flows from these core ideas. Now, before we wrap up, a very important note. The information we have talked about today is for general informational purposes only. It is not professional advice, and it really shouldn't be the only thing you rely on when making financial decisions for your company. So before you take any action based on what you've heard here, it is absolutely essential that you consult the experts. The team at Pro Tax Accountant can provide advice that is tailored specifically to your unique situation. And here's how you can get that expert help. You can contact Pro Tax Accountant for advice on S455 tax or any other business tax issue. You can reach them on WhatsApp or by phone at 7985-689912. You can also drop them an email. For a more detailed breakdown, I highly recommend you check out the full article on their blog. And finally, be sure to subscribe to their YouTube channel for more excellent guides just like this one. Thanks for watching.